With this video, we're going to showcase 10 blue chip dividend growth stocks with yields above 3%, the opportunity for those yields to continue growing in the future, and where we can be very certain that the dividend is safe. And we're going to cover how we determine whether the dividend is well covered and safe or not. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Today's video, we're going to talk about dividend growth and dividend growth stocks. In addition to having the FastGraphs business, I also run a small money management firm. And we actually run two strategies in that money management firm. One is a dividend growth strategy where a majority of our clients are retired. They've worked hard for their money. They have portfolios, and they're utilizing those portfolios today to live off the income. And the goals that we're looking for there is a yield that will allow them to get enough income to live comfortably and according to their normal standard of living. We also want to see that yield grow every year because of, obviously, the ability to fight inflation. And so like they did maybe when they were working, they have an opportunity to get a raise in pay every year. And then we also want to make sure that income is safe, that we can count on that income. And I'll be talking about that as I get a little bit deeper into the video. But the idea here is to look for dividend stocks that provide a yield that is attractive relative to the market. Now, it's not going to pay good quality dividend stocks, don't always pay more than a bond, for example. And in today's rate, we're looking at something around 4%, let's say, call it long-term treasury bonds. So 3% is less than that. But the difference is with a bond, you have fixed income. With a dividend growth stock, especially one that has a great history of increasing their dividend every year, you get an increasing yield each year. Plus, and one of the keys that we're going to look at here are 10 stocks, dividend growth stocks that are also attractively valued in today's overvalued market. So we're going to look at all those things and discuss them and present 10 what I consider to be blue chip stocks with very safe dividends. And then I'm going to talk about how I determine whether the dividend is safe or not. So let's go ahead and turn to FastGraphs and utilize it to help explain what I've been talking about here and why I can know the dividend is safe. And let's look at the 10 stocks that I'll be featuring. So in order to accomplish this, I created a portfolio of 10 blue chip dividend growth stocks. And you can see them here. It's Amgen, Comcast, General Mills, Genuine Parts, Johnson & Johnson, Medtronic, MetLife, Omnicom, Smucker, and Snap-on. Okay, you can see that they all have investment-grade credit ratings. They're all BBB or above in credit ratings. And if we granularize that a little bit, we see half of them are A-rated or better, and the other half are in the BBB to BBB plus category. All right, so they're very good quality companies. As far as dividend yields, looking for 3% or better, and three of them don't really cover that. Snap-on, Amgen, and Genuine Parts, but they're close. They're over 2.8% on the dividend yield. Now, the dividend growth score is something I added to this portfolio view here because anything over 60 or 70 simply means this is what percentage of the time or how consistently are their dividends growing. What's their growth been? And you can see several of them get a score of 100, and the rest all have scores over 70 and over 80 or even over 95 with Smucker. The other thing is they all have earnings yields that are in excess of 6%. Amgen is the only one that's really below what I would call my minimum threshold, which is a 15 PE, which is a 6.67% earnings yield. I like to see an earnings yield above 6.5% to 7%, generally speaking, and all of these are there or they're close. But let's talk about free cash flow and a free cash flow growth score and a free cash flow to equity persistence score. And let me be more precise. Let's talk about free cash flow to equity. Now, the definition of free cash flow to equity is the amount of cash that a company generates, which is available to be potentially distributed to its equity shareholders after accounting for all expenses, reinvestments, debt, repayments, etc. And what is left over here when you're looking at free cash flow to equity, what you see is what's available to pay dividends and also cover the debt of the company. So it's really a very high quality. If companies have positive free cash to equity that are greater than their dividends, then you can be pretty certain or pretty sure that their dividend is going to be well covered. But I do want to make a point. Not all stocks have free cash flows to equity that cover their dividends. I've also put together a small portfolio of 4 dividend aristocrats that have poor records. And if a company doesn't have free cash flow to equity covering their dividends, then to pay their dividends, they either have to borrow money or issue shares. And I'll talk about that more in a moment. But let's go through our portfolio companies here, and let's do them one company at a time. And let's focus on the metric that I think is very important. So starting out here, I'm going to start out with adjusted operating earnings. Okay, and you can see that's the orange line in this graph. And Amgen has grown earnings 11%. The price is currently just a little bit above the orange line, which would indicate that it's just a little bit below my 6.5% threshold. And it does have a 2.88% dividend yield, okay, offering. But let's go ahead into the all-important metric. Is the dividend well covered and safe? Now, you can see by fast graphs, they started paying a dividend in December of 2011, and they've grown that dividend and increased it ever since. But let's move into the all-important free cash flow to equity metric and see if Amgen's dividend is covered. Now, what you can see here, now, one thing I want to do for you, I want to get rid of price and I want to get rid of the normal PE, although you can use this metric as another valuation check or valuation reference or perspective. I'm really looking here at dividend coverage. And I want to keep it simple. The orange line plots the free cash flow to equity. And you can see they've had a couple of years where the free cash to equity was less than the previous year. But generally speaking, free cash flow to equity has increased every year. And most importantly, the orange line is above the white line, which means the company has free cash flow to equity that's more than adequate to pay their dividends and even reduce their debt and do other things with it. So this is the money that's left over to the equity shareholders, or often just called shareholders, the owners of the business. And when you see numbers like this that are well covered, you can be pretty confident that Amgen's dividend is safe, and it has been growing. Okay, so now we can go into our performance report here. And I'm going to drop this down to about a 14-year performance report just to keep it simple. And I'm going to go down here and I'm going to look at oldest first. And we can see that in 2013, their dividend growth was very high. They were still pretty powerful growth stock. However, you can also see that they've been maintaining that dividend growth. Now, their average compound dividend growth rate has been 17%, but it has slowed down a little bit in more recent years. And that's in contrast to the S&P 500 index, if you will, the SPY, which only grew their dividend at 8%. But that's still a pretty good number. But here's the point I want to get at. The key here is the fact that we bought, this is a one-time $10,000 investment, and utilizing that going back to 2013, we had bought 112.38 shares, and our first year on that per 10,000 would have been $211. But I want you to notice the next year it was 274, then 335, then 449, and so on. I call this growth yield. Some people call this yield on cost. Their yield on cost has increased. But the key is if you're living off the income, you're getting more income off your dividend growth portfolio every year if part of it's in Amgen. So let's go ahead and look at the other 10 stocks here. And we're going to look at them from both the point of valuation and dividend coverage. The next one would be Comcast. Now, Comcast has produced very prodigious free cash flow to equity coverage of their dividend. Their dividend is extremely well covered. They're currently yielding over 3.34%. Now, part of the reason for that is this company has been really in the doldrums as far as stock price goes, but operating performance has been quite good, as you can see by earnings here, and the stock is very inexpensive. Okay, now what does that mean? That means if I'm looking at forecasting here, and even if I use a normal PE and I shorten the time frame to like 5 years and get only a 12 normal PE and look at forecasting and go to the normal PE forecasting tab, a normal PE recently has been about 13.5. If this company achieves the 8.9% growth, then we're looking at a stock that can generate substantial annualized rates of return. This is another advantage of dividend growth stocks, and that is the fact that not only do they give you the opportunity to have an increasing dividend or income each year, but they also give you the opportunity for capital appreciation in the long run. All right, so going back here, looking at their dividend free cash flow to equity coverage, the company has generated substantial free cash flow to equity, which would indicate that their dividend is extremely safe. Okay, moving on, let's go into General Mills. General Mills also generates free cash flow to equity that is above their dividend. It has a 3.74% dividend yield currently, and the growth has not been as fast as we saw with Amgen. This is a slower growing stock, but it does offer us a little more yield, 3.74%, and we got very safe dividend coverage, 51% debt to capital, and a BBB credit rating also speaks very well to the safety. Now, General Mills, if I look at it from a standpoint of valuation, and I do that with adjusted operating earnings, and I put weekly closing stock prices on the graph, you can see that weekly closing stock prices have tracked earnings, and you can see times when the stock was attractively valued, times when it was overvalued, and then times when it was fairly valued, in other words, when the price is touching the orange line. And that's what we have right now. So the orange line already has a margin of safety built in. A 15 PE gives us a decent margin of safety. When the price gets a lower PE than that, we even have a better margin of safety, obviously. But this gives us a margin of safety. We can see anytime we'd have bought this stock when it was on the orange line, then that would have been an attractive time to buy the stock and let us fully participate in the growth of the company, plus get the dividend. So we get an increasing dividend income every year and the opportunity to make some money. For example, if we'd have bought it here at a 14.7 PE on November 11th and held it today through all this volatility, through yesterday's close, we'd have averaged over 7% per year. Okay, which is a nice attractive rate of return if you compare it to bonds, and we got an increase in income each year. Again, we can go to performance and going into the dividend here, looking at oldest first, and we can see that the yield has increased from 2.5% to over 9% had you bought the stock in 2005. Okay, now we didn't get as much capital appreciation as the S&P 500. Now I do want to make a comment on that. One of the things about these 10 stocks that I'm showcasing here are not only is the dividend safe, but I believe the investment is safe. If you look at the S&P 500 today, you can see the valuation is extremely high, one of the highest multiples that it's traded at least in the last 2 decades. All right. Now, when we're looking at these individual stocks that we've been featuring today and look at them from a standpoint of their valuation, we see that they're fairly valued. Now, looking at General Mills here again, I do want to make a point. Valuation is so important, and I harp on it and talk about it endlessly. For example, if you'd have been buying General Mills back here when the PE was 24, similar to what the market is now, I want you to note the price would have been $140. The current price is only $64. So in other words, you go all these years and you still hadn't recovered. But anytime you'd have bought the stock at fair value, even if you'd have bought it here when it was reasonably valued and you had this drop in value here, look how quickly the stock recovers. And the point is, we are probably facing a potential to see a drop in the market generally. And by the way, when a falling market happens, a lot of time when the tide goes out, all ships sink. The question is, the ones that are the most buoyant are the ones that are undervalued or fairly valued at the time, because they're the ones that surely are going to be able to recover in the quickest period of time. So let's move on. The next company we're going to look at is Genuine Parts Company. It's a distributor of automotive parts and so on. And again, the stock was overvalued. It's now become into fair value. It's yielding 2.9%. If I look at it from a performance point of view, as far as the dividend growth rate, its dividend has increased by 6% a year. So you're getting that raise in pay every year. If you bought it 20 years ago, your yield would have been 3.63%, similar to where we are now. And today, 20 years later, your yield on cost would be over 11%. All right, so the company is attractively valued right now with good future growth potential. But again, let's go to that all-important metric, free cash flow to equity. And let's look at free cash flow to equity. And again, we're not worried about value in price here. We're looking at dividend coverage. And you can see Genuine Parts has good free cash flow to equity that covers their dividend very nicely. Now, moving on to the next stock, it'd be Johnson & Johnson, AAA rated. It has, again, awesome free cash flow to equity, very consistent, high growth. The dividend here is very safe. It's yielding 3.38% currently, and I do consider Johnson & Johnson reasonably attractive. Now, keep in mind, these are blue chip dividend growth stocks that give you the opportunity for a raise in pay every year. They're not going to make you rich. They're not going to be AI stocks or Teslas that have gone up and down hundreds of percent almost daily. No, I'm joking, but you understand. I mean, these are very consistent, reliable stocks. Of course, J&J is AAA rated, has very modest debt to capital, offers a 3.38% dividend yield. And again, looking at performance over the last 20 years, they've grown their dividend by a rate of almost 8.5% per year, so that's very attractive. And once again, the free cash flow to equity is well covering their dividend. Okay, so I feel the dividends is very safe here. Now, let me take this moment, since we're dealing with maybe one of the highest quality stocks on the planet, AAA rated Microsoft and Johnson & Johnson are the only two that I know of. Let's go ahead and go into the other portfolio here, and let's look at a company like Atmos Energy. Now, this is a dividend aristocrat, okay? They have a very consistent earnings record, and I want you to note they have a very consistent dividend record. Now, one of the things I like about dividend growth investing, and I use it in my money management firm, is this is the most predictable line on the graph, all right? Especially when you have well dividend safety like I've covered with the other stocks. But here's the problem. When I go to free cash flow to equity, looking at Atmos Energy, I can see that the company has many, many cases where they did not cover their dividend. In fact, they rarely cover their dividend with free cash flow to equity. But yet this stock has increased their dividend for over 40 years in a row. So I do want to make a point. Just because it doesn't have an adequate free cash flow to equity doesn't mean it won't continue to be able to pay the dividend. I want to make that clear. Now, I can check a couple of things. What happened is, first thing I want to do is I want to go into fund graphs, and I'm going to look at the balance sheet, and I'm going to look at total debt. And if a company doesn't generate the free cash flow, oftentimes they've got to take on debt. And you can see debt has grown. If we look at, say, the last decade plus, debt has grown at a rate of over 5.38%. But the other thing I can do is go into fiscal fitness here and look at share buybacks, and also note that Atmos has continuously increased their share count. So in other words, even though they don't have the free cash flow to equity to cover their dividend, they're paying their dividend out. They've been either raising debt and also increasing shares. They've been raising capital other ways. So just because a company doesn't have free cash flow covering their equity doesn't mean that their dividend will be cut. But the point I want to get across here is it's a lot more confidence inspiring to know that the dividend growth stock you're investing in, especially if you're retired, and especially if you're counting on that income and counting on that income to continue to grow, it's very inspiring to know that your free cash flow is covering the dividend. Medtronic is another example here where they have adequate free cash flow covering their dividend. Once again, if I look at it from this perspective of current valuation, put weekly closing prices on the graph, I can see that Medtronic has historically been marked at very high valuations by the market. It's currently trading in line with the orange line, offers a 3.5% current yield. It's A-rated with 32% debt to capital, very high quality. It's got an adequate earnings yield of 6.54%. And if I go and look at performance and look at the dividend growth, obviously the company's grown their dividend by double-digit rates. You would have started out with a very low yield in 2005, and today you'd have a yield of over 5.5%. But the beauty of it is today, Medtronic is reasonably priced, which is actually rare. Most of the time, the market overprices this quality blue chip, but you can now buy it with a 3.5% starting current yield and watch that yield growing by 7 or 8 or 9% a year. And again, once again, it's well covered by their free cash flow to equity, covers their dividend, allows them to pay off all their debt and reinvest in the business and do all the things, pay all expenses, all reinvestments and all repayments, and yet still have money left over for the dividend. MetLife is another one. Now, MetLife, I call this a blue line company. The market has continuously discounted this at a relatively low PE of around 10 times earnings. It's currently trading at a 9 multiple, so it's just slightly below the blue line. It offers a 3% dividend yield. It's A-minus rated, has 40% debt to capital. And again, if I look at performance, the dividend has grown by about 6% a year historically, which is attractive. And again, you can see that generally speaking, I'll take these other multiples, they have really a lot of free cash flow covering their dividend. So it's a very, very safe dividend. And of course, that partially explains why it's A-rated or better. Moving on, the next company would be Omnicom, which is the world's largest advertising company. Again, really adequate free cash flow covering the dividend, free cash flow to equity covering the dividend. Once again, if I look at it from a current valuation point of view, very consistent operating earnings growth, very consistent dividend growth. You get a 3.16% yield. The company is BBB plus rated, has an earnings yield of over 8.73%. And if you look at it from a valuation perspective, this is a very low valuation to be buying this blue chip dividend growth stock. If I look at performance on it, dividend growth rate has averaged about double digits, 10%. Slowed down a little bit more recently, I will say that, but it's a very safe dividend, and it's a dividend that I think you can count on. Now, they did freeze the dividend in 2021, 2022, and 2023, but they're expected to begin growing it again. But the point is, it's got a nice high yield. They're going to continue to pay the dividend. I have a lot of confidence the dividend is very safe because of the amount of free cash flow to equity that they're generating. The next one is S.J. Smucker. You can see that on a valuation basis, it's currently very inexpensive, offers almost a 4% yield, a very attractive 9% earnings yield. It has 42% debt to capital, BBB rated. And when I look at free cash flow to equity, I want you to note that its free cash flow to equity is generally, especially in recent years, covering their dividend very nicely. It did get to where they just barely covered their dividend in April of 2011, but otherwise their free cash flow to equity has been very, very strong. And it looks well covered now into the future. The next company would be Snap-on. Snap-on also is another case where they have had some issues in the past, recent decade or more. They have more than adequate free cash flow to equity covering their dividend. Stock offers a dividend yield of 2.84%, nice earnings yield, A-rated, only has 19% debt. So again, if I'm looking at it from a standpoint of current valuation, I look at it from an operating earnings point of view, and it's below the orange line, and it's attractive and a very consistent long-term performer. So there you have the 10 blue chip dividend growth stocks with yields averaging over 3%, most of them offering yields of over 3%. Now, keeping in mind, there are these other companies, for example, this is a dividend aristocrat, Consolidated Edison, which is a utility stock. And as a utility stock, they're often needing to raise capital. But they have very consistent earnings growth, but very low earnings growth, only 3%. They're A-rated, have a 5.78% dividend yield. But again, I want to point out that their free cash flow to equity rarely covers their dividend. Okay, so when you're dealing with a utility like this, you got to go look a little bit deeper. Here, I don't have the luxury of saying free cash flow to equity. They have plenty of money left over to pay the dividend in simple terms. But again, I can go into fund graphs, I can go into the balance sheet, I can go into their total debt and see that the company is consistently raising debt. I can also go into fast graphs into fiscal fitness, go into share buybacks and see that the company is also issuing shares. Now, not a lot. Growth rate's only been about 2 or 3% over the last decade or so. It's only been about 1.5%. But the point is they do have to raise capital to cover their dividend. Even though it's a dividend aristocrat, and you don't have the comfort that you do with the 10 stocks that I showed that have very, very solid dividend growth scores. They also have very solid free cash flow growth scores. They also have free cash flow persistency scores, which I believe is critical. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, presenting 10 blue chip dividend growth stocks with yields at approximately 3% or higher, with the ability to give you a raise in pay every year and the confidence to feel that your dividend is very, very safe and well covered by free cash flow to equity. It's a very important metric when you're looking at dividend stocks to see if your dividend is well covered or not. Again, as I did contrast that with some other aristocrats, it doesn't mean if they're not generating it that the dividend is, you can expect the dividend to be cut. You got to look a little deeper. How else are they getting their capital? But generally speaking, there's a lot of comfort knowing that you got a company that has leftover money to be able to continue paying you a dividend if you're a dividend growth investor and a retired investor perhaps, and living off the income. Anyway, thanks for watching. I hope you enjoyed this. I hope you also get some perspectives of how valuable Fast Graphs as a stock research tool really is. I wouldn't even think about investing in stocks without it, so you might want to take a look at our free trial. Also, if you haven't already, subscribe to our channel, ring the bell, give me a like, and all that good stuff. So anyway, it's been Chuck Carnevale. Thanks for watching, and I look forward to talking to you again in my next video. Thanks.